All right, let's start with the first conversation of the day, and that has to do with a type of investor. I've met quite a few people who don't like the idea of investing in what they think are risky assets. My father, for example, for most of his career, avoided investing in equity because he perceived that as risky. Instead, he maximized his contribution to the Employee Provident Fund. But is that the right approach? Let's ask the expert. Feroze Azeez, Deputy Chief Executive Officer of Anand Rathi Private Wealth Management, is joining me. Thank you so much, Feroze, for taking the time. Good evening to you. First of all, I'll start by asking, how do you identify if you are risk-averse? Because some people think that they are, but they are capable of taking risks. So how do you distinguish between risk-taking capability and risk tolerance?
Hi, Alex. Good evening. Of course, risk is a very important second side of the coin of investing. One side is the return, the other side is the risk. First, before even I get to your question, risk has been a reasonable abstract word. So it becomes difficult for a person to understand their own risk appetite. In spite of having lived with themselves for all their lives, it becomes difficult. So point one, always visualize the worst and see whether the worst is something which is palatable to your mind. If you're investing in equity, visualize that if equities fell by 20% in the subsequent 2 months, what would be your reaction? So visualizing worst days is all about understanding risk and your own risk appetite. Second way to identify your own risk appetite is to see whether you have taken hasty decisions in the past when things have gone adverse. That's the second way, visualizing and then looking back in your life and seeing how irrational or how emotion-driven investing became a key part of your life. That's second. Third, it's very important to measure risk. Risk is actually measurable. Ironically, in the investing world, it is used in English nomenclature: high, medium, low, little, more. All these words are used to describe risk, but risk is measurable. So you have to measure the risk of each instrument you bring in your portfolio. Like Alex, you gave the example of a provident fund. The risk there is zero because you get exactly what you expect. So the deviation from expectation is nil. So every instrument has a different risk measure. Knowing that risk measure helps you calibrate the portfolio's risk and tries to marry it with your own risk. So that's the long story pointed question, Alex.
I think you've answered it very well, and I would very much like you to explain the standard deviation when you're talking about different asset classes. But before we get to that, you've been at this for several years now, and you've interacted with so many people. In your experience, Feroze, do people more often than not take too much risk, or do they take too little?
Yes, Alex, generally, because if you don't quantify something, you're surely sometimes going to go overboard or sometimes not have it at all. And risk is what is a very, very positive term. It's considered a very negative term in India, especially Indian investors. So to answer your pointed questions, if you don't measure something, you're definitely going to be going extra or lesser than what you should. Like if you don't measure your weight for the next 2 years, you may not be having your body mass index in the same ratio which it should be. So not measuring itself is the reason why people go overboard several times. But having said which, Alex, I would definitely want to highlight that sometimes you're not born with a specific risk appetite. You develop an appetite for risk. Like Japanese food, you develop a taste for it, right? So risk is something which you're not born with. How do you build a healthy risk appetite is by understanding what you're doing. If you already expect a certain outcome, and if that outcome happens, then it's not a shock or a risk. Every year, for example, over the last 21 years, markets have fallen from peak to trough 20%. Every single year, average has been 20%. So if you're an equity investor, assuming that markets will not fall more than 5%, you're sure going to be surprised in the journey. So knowing what's going to happen itself mitigates the risk, and your rational thinking prevails during adverse situations.
Feroze, I love the analogy of measuring your weight, because this is something that I have to struggle with, and that reminds me that I need to check the scale today. And I also like the comparison to Japanese food and sushi, because that indeed is an acquired taste. But let's talk about the measurement of risk. You talked about standard deviation, and this is what I think a lot of people study in school in statistics class. Maybe they don't pay too much attention to it. But how would you explain this to people so that everybody can understand it?
Yes, Alex. Unfortunately, in the world of finance, for simple concepts, they have used nomenclature which sounds more intimidating. Standard deviation itself as a name is a very, very intimidating name, but it's very simple. Standard deviation is nothing but the deviation possible from your expectation. For example, if in an equity fund, your expected return is 15, if you're expecting a return of 15% every year, and for simplicity's sake, if the standard deviation is 5%, it implies that 15 plus 5, which is 20, 15 minus 5, which is 10. This becomes the most likely range of return, which will be the future return. That's the most likely. That's called the one standard deviation range. So standard deviation is nothing but a measure of how much can the return move from your expectation, plus or minus. Smaller this number, tighter is the range of returns the instrument can give. For example, if you take a debt fund, the standard deviation is generally less than 2%. So if you buy a debt fund with an expectation of 6%, you may get 8 or 4. That's a very tight range. But in an equity scheme, your standard deviations are larger. So the possible return outcomes could be varying in a larger range. For in stocks, the standard deviation could be 25, 30. That implies that the pendulum can swing either sides very wildly.
How do you then push this further and talk about somebody's risk-taking capability and risk-taking or risk tolerance level? It has to do with expectations, and it obviously has to do with standard deviation as well.
Yes, Alex. One is capability and ability. Both are a little different, Alex. See, if I am very close to my retirement, I may not have the capability to take risk. I may be a risk-taking person, but if I just have 2 more years to earn and I have to accumulate a corpus, am I inherently a risk taker? The answer is yes. But do I have the capability to take the risk? No, because I just have 2 years. If something went wrong in the last lap or the last few overs, and if you don't have the wickets, you may not be able to bat. So the point I'm trying to make is capability of taking risk depends on the context in which you're operating. If your goal, now if you want to send your child abroad for his further education and it's just 1 year away, can you have money in equity? The answer is no. What if you have to cut a check to the school globally and you don't have the money? At that point in time, the markets are low. So that's not having the capability to take the risk, but still having the risk appetite, but not the capability.
Let's talk about how a risk-averse individual, and that indeed is the topic of today's conversation, how should they plan their finances? Because a risk-averse individual would not be too comfortable with a large exposure to equity. And despite that, when you're talking about achieving long-term goals like building a corpus for retirement or saving to buy a house a decade from now, you're encouraged to look at equity because it gives you the kind of returns that help you achieve that goal in the manner that you should. But what if a person is not comfortable with that risk? How do you construct a portfolio?
See, Alex, I'm very tempted to digress from your question a minute. So what happens is, equity is risky. Okay, that's the current perception or general belief. But in equity, you have different instruments which can be 3-4 times riskier than the other instrument. But all of them are called equity. An equity mutual fund is called equity, which will have a standard deviation of 10, 11. There is a stock, which is also called equity, but the standard deviation of that could be even 70. So equity mutual funds is 7 times, is 1/7 the risk of that stock, but both are still called equity. So when you don't want to take the risk, it doesn't mean that you dump the asset class and say equity is complete no-no. No, you would not go in for stocks. You would not go in for PMSs. You may not go in for sector mutual funds, but a large cap mutual fund could be 1/10 the risk of a stock. So don't paint all equity instruments in the same brush, is the one submission I have. Now coming to your question of how do you prepare a portfolio? Very importantly, if equity mutual funds are not going to be even a small part of your portfolio, you beating inflation is going to be very difficult. We live in a country where inflation 5, 6, 7% is a norm. Today, debt returns, if you look at the last 6 months, 1 year, 2-year returns of debt funds are in the range of 5 to 6%. So if you have to beat inflation, which is not if, you have to beat inflation. And if you have to beat inflation, can you have zero in equity? The answer is no. So am I advocating a stock portfolio for a risk-averse investor? Again, the answer is no. So buy some mutual funds. 20 to 30%. If you have 30% in equity mutual funds, 70% in debt, you will have an 8% expected return and your standard deviation will be 5%. So the range of return will be 8 plus 5, 8 minus 5. So this is a low risk portfolio, at least having 30%. If you want to have little higher return and 8 is not as appealing, go for a 50-50 portfolio. You will have a 9% expected return with a standard deviation of 7, which implies 9 plus 7, 9 minus 7. So these are the two desired portfolios a person can construct with at least 8-9%, so that your real return, so that you're at least beating inflation by 2-3%. Alex, that would be my recommendation for a risk-averse investment.
You started with talking about painting an asset class with the same brush, because that was going to be one of my questions, in that if you have an approach, and I also want to ask you, Feroze, in the interactions that you've had with individuals, and I speak to people when they're talking about crypto assets, for example, there is so much fervor with which they talk about the potential that these assets have. There is maybe not a complete understanding of the risk involved. So do you think that it's important to look at an asset class and subdivide it and splice it and understand it better before you put your money in, and that is a crucial leg of the investment process?
Alex, very, very important question. The biggest problem is people plunge into things with their hard-earned monies without understanding the asset enough. Sometimes they paint the entire asset with one brush. Sometimes they really get very excited with last 1 year returns, last 2 year returns, and jump into the bandwagon. Now that you've brought up crypto, we did an analysis and found out if you compare the strongest crypto or the highest market cap crypto, which is a Bitcoin, and look at its behavior over the last 1 year, after it finished a decade of existence. Last 1 year, it has moved 10% in a day, 17 times. 17 times Bitcoin moved more than 10% a day in the last 1 year. Nifty didn't move even once 10% a day. It moved 126 times, more than 5% a day. Nifty didn't move more than 5% a day even once. So the point I'm trying to make is that's the safest crypto for you. That's not the riskiest crypto. So understanding that risk, I'm not saying there is no merit of having crypto, or I'm not advocating, but I'm only advocating understanding where you put your money as much as you can, because it took you hours of effort, service, selling some product to earn that money. So it's your duty to understand where you're parting it with.
I couldn't have said it better, and I'm glad that this is the message on which we are ending this conversation. Thank you so much, Feroze, for laying that out. And I'm sure a lot of the investors tuning in will also be able to look at their portfolios now with a better understanding of risk and how to apportion their assets. Thank you so much for taking the time.